Hello, brothers and sisters. This is Brother Lewis coming to you during the Thursday office hours. Nobody showed up, so I figured I'd go ahead and do a quick review of Chapter 7 and Chapter 8 using, the, oh, mercy, the cheat sheets that are on for both of these, just to maybe either point to a couple of videos I've already done or to maybe provide some additional context around some of this information. Now, Chapter 8, you're dealing with receivables, right? And so fundamentally, you've got either sales on credit, right? Or which would be very similar to a credit card actually as well. But this bank card, I guess, is like cash, right? So you have on credit or by cash, really. They're showing this bank credit card because of the credit card expense that you end up having. But whether it's cash or credit card, either way, you end up having the same. So what you have on sales on credit, this first part right here is when you actually do the sale, right? So it's going to be a debit to accounts receivable and a credit to sales. Increases sales, increases accounts receivable. When it actually gets paid, right, you're going to get paid by cash, then it's going to be a debit to cash, and it's going to be a credit to accounts receivable. Now, why they have these two different, I don't know. That's kind of confusing to me. If you sold something to somebody like Comp Store, and then they paid for it, then really, the easiest way of looking at this is 950 and 950 and 950 and 950. That way, you can see that effectively, right, this item receivable gets cleared out because you have a 950 and 950, the debit and credit. What you're left with is an increase in sales and an increase in cash. Now, when you do just a sale, and so receivables is zero. When you do sales via a bank, credit card, or even cash, then you're always going to have cash because that's increasing your bank balance. And then you're going to have a credit to sales, which increases your sales. Now, if it's by credit card, of course, there's some percentage, ranges anywhere from, like, for the companies, 2 3/4 to maybe 3.5%. It is rounded off to 4%. And so this is the way the transaction will look for a credit card sale. Now, when you're looking at accounts receivable and thinking through what if you don't get paid, right? So what if Comp Store never pays you, or they don't plan on paying you for some reason? Well, you're gonna have to write that off, right? And so what you end up doing, there's two methods: the direct write-off method or the allowance method. So in this case, the direct write-off method would expense it directly to bad debt, right? It's a debit to bad debt expense, and then a credit reduces accounts receivable for J. Kent by the same amount. Then if and when J. Kent ever pays it, then there's a couple of ways of looking at this. The most simple way is to look at just these two parts right here, right? You would reverse out the bad debt, and because you got the cash, right? So increase in cash, decrease in bad debt expense. But because you want to show that receivable and then the relief of that receivable, you would reestablish that receivable. So reestablishing it, meaning you would debit accounts receivable for J. Kent and pull it out of bad debt expense. So reduce bad debt expense, increase your accounts receivable. And then you would record the cash that you received and zero out that receivable, right? So it's kind of a long process of pain in the hiney when somebody doesn't pay, and it's even more of a pain in the hiney when they do pay after you've written it off. But, in the end, you got your cash. That's the direct write-off method. The allowance method primarily keeps your accounts receivable intact, right? You never have to do this gyration of removing it out of receivables. That said, you do at some point, but really what you do is you first estimate your bad debts. And so you have a bad debt expense. Let's say you assume that $1,500 of all your accounts receivable is not going to be collectible. So you put in $1,500 and then you remove. You put an allowance in for doubtful accounts, which really is a contra account, right? So you have your accounts receivable balance. Let's just show this real quick. Let's oops, wrong one. That's not what I wanted. Right. Oops. So, you may have your AR balance of, let's put this in the debit and credit standpoint. You may have, let's say it's $150,000. Then you have your allowance for doubtful accounts. Let's say this is a trial balance, yeah. Then you'd have your $1,500 sitting over here. So the net amount equals what, $145,000. No, 100 and it's 485. Oh, 145. This is so bad. That minus this, right? 148,500. Okay. So much for my math skills today. Anyway, so the net balance, if you were to record it that way, it shows something like a net is be something like AR net of allowance, right? Allowance would be the 148,500. So that's what this effectively is doing right there. And then what ends up happening is when you actually write off that bad debt, you clear it out of accounts receivable, you're going to charge it to allowance for doubtful accounts. So let's say we go back here, right? So the net, we did our allowance right here, and then we say, okay, well, we're actually going to write off an item. So what was that number there? Number there's 520. Okay, so do our allowance for doubtful accounts. That's the 520, and it goes to bad. That doesn't go to bad debt. It goes to accounts receivable for the particular. So J. Kent, yeah, J. Kent. So it's for 520. So now, effectively, inside of this accounts receivable balance, there's something for J. Kent. It's reduced by 520. And now your allowance for doubtful accounts, if we do a T account here, allowance debit and credit would first have a transaction of 1,500, but then it's reduced by 520, right? And so that's how, if you start tracking just the T account on this, is how that's going to look. And J. Kent has some balance, I don't know what, but it's probably either 520 or more. And then when it's recovered, you do the same gyration as you did as a direct, right? You have to reset up the AR. You have to then put in the allowance, reverse the allowance, and then do what you do here. So now if you do AR J. Kent to set it back up for 520, then you have to pull it out of the allowance. And that's the 520. Then you have to show the cash receipt of 520. And that's right. Oh, I did this wrong. Let's go back here. Allowance, cash, and receivable. Oh, because you paid it off. Duh. Yeah, and then you have to do the AR for J. Kent for 520. Okay. Right, so a little confusing here, but what you'll find is in this case, right, these two offset each other. So now there's nothing in the accounts receivable. You have to put a receivable back in place that you can then actually this offsets some version. Let's just say Kent balance equals 520. Okay, so this balance is a debit. This clears it out. This puts it back in, and then this zeroes it out again. So you really have this ping pong effect on write-offs. Okay. Now, estimating bad debts, this goes through, your two different possibilities: percent of sales, one option, right? Your sales times your rate equals your bad debt expense. And you make your adjusting entry depending on what you end up having. Usually this just goes straight. Usually as for your allowance. And your balance sheet focus is your percent of receivables or the aging of receivables. Now, I've done a video on both of these, actually all three of these. So you should be able to walk through those variations and see how to create not only the allowance, but then figure out what the journal entry should be. So, sorry, I just had to put chocolate in. So let's say we're in this case right here, right? Ignore that we got paid. And if we do a percent sales approach, let's say it's 2% of sales, and sales revenue for the year was $1 million. Okay, our allowance would be the $1 million times 2%. Let's give us a good old dollar value. Whoa, what did I do there? Oh, that's what I did. Equals that times that. So it's $20,000. That's a lot of money. Okay. If this were the case, then we want to bring this allowance balance up to $20,000. All right. So let's put my little formatting geniuses in here. Okay. Let's just do it this way. Left. Okay. So we want this to equal that number. Okay. The only way we do that is by putting in a number right here. It's going to take really that minus this plus that. So this is going to equal 20,520 minus the 520 equals to $20,000. Right. So this is what your allowance entry should be. And the way this looks is you're going to do a bad debt expense, and you're going to have your allowance for doubtful accounts. Right. So that's going to be 19,020, and this one's going to be 19,020. Okay. So that's how you end up doing your entry based on a percent of sales. Now, if I'm doing it based on aging, right, then you're going to do the same thing. You're going to come up with usually you're going to have a zero. Well, it's really 1 to 30, 31 to, let's do this in, sorry, 1 to 30, 31 to 60, usually a 61 to 90, and then let's say over 90. Okay. So we'll just call it total here. So let's say I've got, say let's say, what do I want to do? Let's say I've got 250 here. I've got 25,000. Let's not make it 25. Let's make it 10,000 here. Let's make it 5,000 here, and let's make it 50,000 there. Let's make this one 2,000. Okay. Total equals sum all these. And let's say just that as a percentage, we're going to assume that this is 0% because it's still within 30 days. We usually get that all paid, but anytime it goes over 30 days, it gets progressively worse. So let's say this is 3%. No, let's call this 10% of that. Let's do 25% of this. Let's do 50. Let's do 60% of this. Okay. And we take the number times the percentage, run it all the way across, and we get a total, right? Okay, so in this case, it's 14.7, right? So once again, we want to get this number. So this is option 1. This is option 2. We want to get this number to be the 14.7. So now that I have my formula in here, it tells me what this value should be, 13,720. So instead of 19,020, it's going to be 13,720. Okay. And very similar for the other, percent of receivables runs exactly the same as percent of sales, except you're basing it on accounts receivable instead of your sales rate. Now this is if they have sales rate times equals your bad debt expense. This is a direct write-off method. These are usually, but if it's not a direct write-off method, they use the percent of sales as an allowance method, then it wouldn't go directly to bad debt expense. Okay. So your notes receivable. I noticed there was a question from one student about, what are the terms for like a note receivable or a and so you have who what was it? I have to remember what the terminology they use. Who issued the note, who holds the note, what's the principal of the note or the stated value, what's the interest rate of it, what's the market value. Most cases, notes receivables, the market value is the same as the stated value, unless you're also selling the interest that's tied to it, and so that might have a slightly different value. But for the most part, these are the things you're going to have to worry about. A note receivable is a promise to pay a specific amount in the future. You have a principal amount, you have a maturity date, and you have an interest, usually assumed to be 360, an interest rate. Okay. So when you first take out, when you issue, if you are this is note receivable from sales. So effectively what they're doing is creating an accounts receivable, but this is called a notes receivable. Same type of thing. You're going to credit sales, which increases your sales and increases your asset, a notes receivable asset of $1,000. This is an example of when you're exchanging, what you're clearing out, let's say a receivable in exchange for some level of cash and then a note, because usually receivables don't carry with them any interest. Some do. Your terms may be have an interest clause in them. Most don't. And so you're exchanging out some receivable that has a 0 interest rate at top tied to it to a note receivable that does have an interest rate on it. And so they paid $232 in cash, clearing out the accounts receivable and exchanging it for a $600 note receivable. Then when it's paid in full, this one would have been what, $600 principal balance at a, what is that, So does it give you the interest rate? It doesn't. We can figure out the interest rate here. So 15 divided by equals 15 divided by 600. So somehow it was a 2.5% interest, assuming that it was done within a month. If it was over a month, it was, or less than a month, maybe the interest rate is actually higher. But you can figure that out by doing some of the math there. Go back to my thing here. Oops, wrong one. Okay. So this is the, whatever the calculation is, interest. Here's your calculator. Principal to note times the interest rate times the amount of time over a year, right? So you can actually back calculate this. Let's do it this way. So if your principal, your interest rate, and your days divided by 360 equals your interest, right? So we know that 600 is here. We don't know the rest. It makes it a little bit difficult. Yeah, can't back calculate this. You can come close. We just don't know how many days, and we don't. We have two variables we don't know. We can solve if we had one variable. We don't have both. Okay, that's when it's paid with interest. This note is dishonored. Accounts receivable, interest recorded. Oh, they're clearing out the receivable and putting it back, the notes receivable, putting it back in accounts receivable and recognizing the interest associated with it, which this is like rare. I don't know when you would ever do that. You would just go collect the note receivable and whatever outstanding interest is associated with it. This is a journal entry for accruing the receivable. So every month or periodically, you're going to identify how much interest has been accrued on that note, and then you're going to recognize it. So this is the receivable on that, 15 bucks, and this is the revenue associated with that interest. Usually it's called interest income, and it shows up below in earnings before interest, taxes, and depreciation or amortization. It's called EBITDA. And this usually shows up after that. As an other income, other expense. And then when the note is honored, if you got, paid the 615, you'd put the cash in there. You would clear out the receivable from that, and from the note, and then anything above and beyond that was, let's say, past the current period where you have recognized receivable, you would just record the interest. There's a couple of other things. Factoring. I'm not sure you're really going to get into much of this, so don't worry about that. Okay, so that is chapter 8. Hopefully that helps out. Please make sure to look back at the videos I did on the receivables. That should help you a little bit more. Okay, so that was receivables. Let's go back. That was chapter 7. All right, chapter 8.